Thanks for being there, obviously. I'm going to talk about DeFi market data. I want to talk about DeFi in a CeFi week, and more specifically on why do we think that the market data in the space is one of the key to go forward. Kaiko, who is Kaiko? Kaiko is a data vendor. We've been created in 2014, so around in the space for some long time. We are a leading crypto market data provider, connecting to more than 150 exchanges, but also decentralized financial exchanges, and we distribute that data across the financial markets to banks, financial institutions, other resellers, and a number of other players like startups, but also academics. This is to showcase the kind of clients we have. All these names are actual clients. We got on the top left research from institutions like the OECD or Messeri, for instance, the buy side, financial markets, product issuers, and venues and infrastructures. So Kaiko is really part of the game. I want to talk today about DeFi. It's a very funny week with what happened with FTX. I want to focus on DeFi. And the first thing I want to say is that DeFi, decentralized finance, and the automated market maker that comes with it is the most innovative market structure that has been around in the last 25 years. My own background is from exchanges in the regulated industry. I was the first salaryman of the energy exchange in Europe. I was the general counsel of this exchange, and I started working in the early 2000s when the exchanges shifted from PIT to digitalization. What we had seen at the time was a massive opening of the market. A massive opening of the market. It was unfeasible for the market participants in the mind to shift from PIT to electronic. And what's going to happen with DeFi is exactly the same thing. A massive opening on the market. The reason why is that the three elements that I'm mentioning here haven't been around. I've never been around. They've been invented with DeFi. So it's the first time in the financial industry that you can represent cash and the asset with the same instrument, namely the token. This is the first time ever since finance was invented in the Middle Ages, that we can represent money and the asset with the same instrument. It's the first time in history that I can transfer that to you directly from my account to your own account. Actually, we do that with cash. With the actual cash. If I give my cash to you, you have it. But ever since it was more sophisticated, it's intermediated. I'm not part of those who say there is no intermediation anymore, but I'm saying that when you have the token into your account through a DeFi protocol, you own it. And that is going to open market dramatically. It's the first time ever that this happens. The automation of the transfer of an instrument through a computer program. DeFi is underestimated. This is data we produce. It shows that the market share of DeFi is around 30 to 40% in crypto market today. It's a hedgehog thing. It went up to even to 60% if we compare, for instance, Uniswap with Coinbase. But the trading in DeFi accounts for more than we think. The second reason why DeFi is going to be part of the game is that the bridge is starting to being built with traditional finance. So first, crypto native created DeFi protocols, and now what we observe is financial institutions like JP Morgan Onyx this week, or the BIS with Project Mariana, are considering DeFi protocols to manage the instruments that they want to promote on this technology. Actually, DeFi protocols, they've been invented a few years ago as a response to another crash, not this year's crash, but one of the crashes before. And they're just a great invention. DeFi protocols are about a computer program managing the swap between two assets. So say you want to get rid of stocks and you want to buy other stocks. Today you have to do two operations. You have to do a sell and to do a buy. Well, tomorrow you can just swap. This is what's going to come. If you're part of a big company managing the balance sheet and the reserves of your financial assets, and you want to swap for, I don't know, whatever internal group purposes or any other purpose, you just swap. Get rid of Tesla and acquire IBM. And the price is a synthetic information that is just deriving from the amount of token you can exchange against the other tokens. I don't know, I can exchange a kilo of rice against 4 eggs. So we are back to the basics of the finance mechanisms down in the way forward. It's going to be the same. DeFi protocols are the same. The price is a synthetic thing. Instead of saying I'm going to sell for that price and buy for that price, well, I'm going to give you X in exchange of Y amount of tokens, and this X and Y makes the price. Therefore, it's data-driven. What I'm saying here is that in the previous slide, we saw DeFi is a reality today in crypto. With this slide, we see that DeFi is going to be a reality tomorrow in current finance. So stocks, bonds, structured products, swaps, futures and options, you name it. You name it. So Onyx did a first experiment called Project Guardian. And this one is a very interesting one. If you're a central bank and you want to manage your stock of central bank money, well, you want to exchange euros against Singaporean dollars, or you want to exchange euros against Swiss francs. Well, central banks have studied automated market maker systems for a year and a half now. So there is a narrative that is very crypto, and it's a valid one. DeFi protocols bring a new field of liquidity. But there is also another narrative that not many people know, that DeFi protocols are probably part of the game, are probably some of the future market infrastructure that we will have to deal with in the future. And no later than in August, the G20 said it. So there's the crypto narrative and the fight between stablecoin and CBDCs, etc. But in fact, DeFi is there to stay. The word is a new normal, like after COVID. So this is not a crypto native who say that, it's the G20. And the reason why they said it is that all the regulators all across the world, they have produced papers around DeFi, studying the phenomena that was around crypto assets. But what they pointed out was, oh my God, there's a new market infrastructure. It is as powerful as the digitalization of the markets in the late 90s. All those reports, what they do, between 30 and 60, 80 pages. Some of them are even not anymore reports, but working plan. They list the issues for a massive adoption, a translation of this or usage of these protocols within the traditional finance. And they list all the topics. Yes, there are problems. There was the Terra Luna crash. I'm just going to come back later on that. You got AML, KYC. You have to over-collateralize to transfer assets, while finance is all about credits. How do we do? Maybe we don't know how to manage any potential market abuse, if there is any. So there are a number of problems, cyber threats, operational resiliency. But if you read those documents, they are written in the format of a program, of a working program. And there are massive investment by banks, by institutions, by regulators on how do we handle this new market infrastructure in the future. So tomorrow in DeFi, you will have Uniswap-based or Curve-based or RV-based or similar protocol-based market infrastructure not only for cryptos, but also for financial instruments. So, once we've said that, why did I call my topic the power of data? And sorry for the funny name, but you have to advertise. Okay, if it's a new market infrastructure, it's a market infrastructure in the first place. So someone has to provide the market with the data that traders need to operate on that infrastructure. Traders, research and analysis, pre-trade, trade, post-trade. What do they need data for? They need data for backtesting trading strategies, for instance. If I want to not only trade on centralized exchanges, but use these new pools of liquidity and benefit from a price difference, for instance, well, I need to train an algorithm. I need a huge set of data, and I need to backtest before I go and enter the market. Research and analysis would probably come before that, with the research and development department, telling me, okay, it's a new asset class. How does it behave? It took years in the centralized order book, in this digitalized format, to figure out that, well, if you send a huge order, it's going to have an impact in the price. What are the mechanisms? The financial industry had to learn how to deal with centralized order book in an electronic format. Well, this is the same thing. As DeFi becomes progressively a mainstream market infrastructure, we all have to learn on how it behaves. How does it? I can't put a trade, an order, and then withdraw it. When I put it, it's executed immediately, where there's a difference with the central order book. So we have to learn how it works. And for that, you need data. Pricing and valuation, charting and analysis, indices, and all sorts of pre- and post-trade, risk management, reporting, whatsoever, et cetera, et cetera. All these data that you have in traditional finance, you will need in decentralized finance. And that's what a data provider provides. With a novelty, which is blockchain and the token system. So in the world before blockchain, you had to go and fetch data. The image I take is Tesco, because we're in England, Selfridges. You have as a user to list the data you need, to go to the shop and fetch it. Every image has its limits, so bear with me, that is just a metaphor. Today, however, the reason why it's transformational is that every information that is relevant or that is needed for the operation of the market infrastructure is on-chain. So it means that it is accessible. And my two images here are, yes, but is it easily accessible? Well, no. If I open for you the door of an Amazon warehouse, and Shane, I ask you, give me the toothbrush, and give me the toothpaste, and also I need a towel and some soap, you would be quite embarrassed because you're here and you don't know where it is. So that's the ambiguity of the new paradigm in which we are. It is transparent in the sense that anybody can access it, but it's a hell of a work to be able to fetch the right information, to know that it's this one, and to contextualize, to put it into context together with the other information that make relevant data. The beauty of the thing is that with smart contracts and the technology around blockchain, data now comes to the user. This is why I took the new Amazon, drone. You just specify what kind of data you have, and instead of fetching it, it comes directly into your smart contract or your API if you're still in the traditional world. So data providers are there not only in DeFi to bring the data products that are absolutely necessary, but they also have to invent the infrastructure to bring it efficiently in a modern way in the DeFi environment. So now let's go and see an example. Okay, there was a crash this week in the CeFi industry. But let's not forget that there was also a crash in the DeFi industry called Terra Luna, which is of course a bit sad. For instance, the power of DeFi market data is here. And there is a typo here, it should read 13 and not 10. But you remember, there was a situation in the Terra Luna ecosystem with the UST being one of the most vastly traded stablecoin across the globe, and that crashed in 3 days. 3 days is a short period of time and is a long period of time. It's a very long period of time. Because of the DeFi market infrastructure, every information is on the chain. If you use what we call our products liquidity pool snapshot, you could have observed on the 8th of May something wrong. I mean, I don't want to enter into details, but if you see two flat lines and then suddenly something that happens, whereas the two flat lines have been flat for the last year and they're supposed to be flat, there's a sign. Something's happening in the market. What is it? You should start and come back from lunch and start looking at the market. So building alerts based on liquidity pool snapshot data is very easy. You don't need a PhD to do that. It's someone, a trainee can do it, plugging into the API and building some alerts. What you need to do is to have the intelligence in your alerting system based on your own trading purposes. In which market are you active? What kind of products are you trading? And based on that, what is the risks you're addressing? What are the risks you're addressing? You build your own risk framework. The power of DeFi data is that you can have access to unprecedented amount of information, which in the history of finance, ever since it was invented, wasn't available. First alert. Second alert, individual swaps data. We've got the products not showing only the position, but what's happening. Suddenly, you see very big amounts of selling. The market is like this, and then suddenly there's a huge amount of selling. Well, what do you do? Isn't that another sign? I mean, suddenly if everybody sells something, is it a good sign? Probably not. So you start caring about your own book. You start wondering whether you should take countermeasures and start inquiring what's happening. And the third alert, sorry, it's not 10, but 13. In these protocols, tokens are brought in by liquidity provider on the one hand, and they are traded by traders like you and me on the other hand. Well, one of the liquidity provider took away such a massive amount of UST in one go that it just caused the crash. So, and that you can see here, 21 million. Usually the maximum amount of tokens that were withdrawn were like 5 million. It was such a big thing. If someone suddenly, if it's extraordinary that someone takes out 5 million and suddenly you see someone taking out 21, you just react. You call everybody back from lunch and maybe you sell, you close and whatever. And the market didn't crash in 10 minutes because then it spread into CeFi and then it crashed. So if you had the products that we have, because that's still a pitch in the end, if you had the product that we have, and if you have made your own homework, defining your own objectives, your own risk framework, and the way you want to monitor it, we're not telling you what to do with it. We're giving you the power to monitor your own data. You would probably have found a way to maybe lose a bit less than the whole book. A second example is not a live one. The second example is a paper by the BIS, the Bank of International Settlements, called Embedded Supervision. Embedded supervision means that if liquidity develops in this market infrastructure, I, as a regulator, do not have to ask everybody else to send me information, and we know 60% of it is wrong. I can go and fetch it by myself. Obviously, they won't be able to fetch information by themselves. They need supplier. I mean, it's like You need a cloud provider, well, you need a data provider. But every information needed for the supervision of the market is there. Therefore, the supervision is embedded within the market infrastructure, and that's very interesting. It is I would like to give a sort of a positive, energy here after FTX crash. It is a good news. It is a virtuous circle because the information is there for everybody to check, including the regulator who's there to make sure nobody's gaming the market. I want to finish by having a heavy slide, which I don't want you to understand. I just want you to feel that obviously bringing that data is a business. Kaiko is a Series B company. We've raised 70 million euros in the last 18 months in a Series B with Alven, Revaya, Blackstone, and other major investors. It's a full institutional grade company. We are a SOC 2 labeled company. Our indexes are BMR compliant regulation in Europe, for those who know that. The reason why is that it is an infrastructure to being able to fetch data from decentralized financial protocols, package the right information, market data information, and distribute it to the right channels across the industry, including Bloomberg, Deutsche Börse, and the backbones like ICE, BTZ, etc., etc. So I hope I've convinced you. Was an open pitch, and Sean, I think I've finished. Thank you.
That was amazingly comprehensive, and you've really built a powerhouse on data. It's wonderful in crypto, as you rightly said, everything is there on chain. So from a data's person's perspective, it is a data dream, isn't it?
It is, sorry?
It is a data's dream, because all the data is there.
Yes, but we are very humble. Bloomberg has been existing for ages, and actually the crypto data from Bloomberg comes from Kaiko. So what we think is that there are new market infrastructure coming. Some things will be overwhelmed in the way we do it, but the businesses will remain the same. Traders will keep trading, exchanges, and this new market infrastructure will keep providing infrastructures, data vendors. So we just have to adapt, and it's true that it's a data-driven world.
Yes, absolutely. So have you had time to make any analysis on the last 48 hours with FTX, or do you have any of your own personal view on what might have happened or might not have happened in that situation?
Yes, and I encourage you to read the deep dive that we published, and it's followed, we have a very good coverage. With the, let's say from a market analysis point of view, what I would like to emphasize is that the crypto have been brought around by a no-limit generation, which is just great. I don't believe you can revolutionize anything without being totally no limit. Now, the sort of attitude towards regulation and the rejection needs to be rethought in a way that segregation of accounts, credit, knowing who you are, making sure nobody's gaming the market, this is what is regulation. So probably the absence of a framework has played a role. I don't say it would have prevented anything, but it probably let the thing be much bigger than it could have been.
Yeah, I suppose I think the first thing that came to my mind was where was the compliance oversight? Where was the checks, the balances, the procedures? At the end of the day, although FTX might be run by a young gentleman, Sam Bankman-Fried, or it might be a young company with regards to its years, but ultimately they were a counterparty to so many people, and they had also raised quite a lot of external venture money as well. So I know Sequoia had invested several hundred millions into it. So I'd be interested to know, did they have a board seat or did they have supervision? But what processes and procedures were put in there, which would have been very traditional type processes and procedures and measurements to make sure that this type of thing mightn't happen. So I'll be interested to see that side of it as well.
Absolutely. So I've been a general counsel of a regulated exchange in the past in Europe. So the regulation is twofold. The first one is making sure that the market is fit and proper, that is sound, that no one is trying and game. So this is not the market infrastructure itself, but the participants. In the case of exchanges, not DeFi. DeFi, we have to invent another system because it's automatized.
Yes.
But for exchanges, somehow they have to check that. As an infrastructure, the question is, how is the industry willing to have massive amount of money given into custody to businesses that are not controlled by anyone, which is the case in most areas, maybe bananas or fruits and things like that. But in the financial industry, usually there has always been a dialogue between self-regulation and supervisory authority regulation. In our case, we haven't really entered that dialogue yet, and I think it's time we should.
I suppose it's quite difficult because, like traditional finance, you'll be focused on the financial hubs of the world, whether it be New York, London, or Hong Kong. I suppose with crypto and blockchain, these businesses, these projects, these exchanges can be spun up in numerous different jurisdictions. And also, they're not labor intensive, where it's not like you've got a Citibank with 100,000 employees. On some of these exchanges, it can actually be 20 or 30 people. So they can be in jurisdictions which, from a regulatory perspective, might not be as sharp or as mature as some of the financial hubs, although these guys are doing the same level of business. So jurisdictionally, it's quite difficult.
Yes, but it's the same now.
Yeah.
We live in the UK or the Europe or very highly regulated areas, but others are less. So it's not new. The fact that you have global businesses is not a novelty. What I think is going to be extremely interesting to observe in the coming weeks and I mean days and weeks and months is how the industry itself reacts, because the timing of lawmaker is longer, and it's not going to be possible that the regulation captures it because it's not built yet. It captures it immediately. So the reaction of ourselves as an industry, how we react to that, is going to be a very interesting development to observe.
Ultimately, I think it's negative in general, and I think we'll see a lot of our traditional finance guys that were looking at deploying capital into the space, and it really starts with the regulatory and compliance, which will do their due diligence on it. When they see drawdowns of this magnitude happening this fast. And it was funny, you mentioned 3 days, you said it wasn't a long period of time, but actually it was a long period of time. When you saw what happened so quickly in the markets in a several hour period, I think traditional finance, compliance and regulatory staff at institutions that are looking at deploying capital, yet again, I think this is a hurdle for them, because it looks like the market fell apart so quickly, so fast, with very little stops in there, and that's scary because it's hard to get downside protection in situations like this.
I'm extremely optimistic, and I'm not candidly optimistic. The reason why is that it shows what needs to be addressed.
Yeah.
In a much more clearer way. It's very sad. I would have loved not to have experienced that, but it shows what needs to be addressed. The potential of tokens or DeFi, which not even talking about DeFi, but even the token itself has a great potential. We always, air miles, I don't know, there are many ways that we need tokens as an asset. DeFi is coming with a new infrastructure, therefore it's there to stay. And financial professionals, they know that it's not built like this.
Yeah.
In the futures and option markets, which was my area, it took 30 years to do close-out netting and to try and find a proper regulatory. So maybe crypto goes faster, so it's not going to be 30 years. But I'm very optimistic that we find a good balance.
Yes, and actually I say this all the time. It's not necessarily where we're at, it's where we've come from. And if you look at how complex the market has become in the last 10 years, from literally zero to what it is now, you guys are a great example of that, offering the service that you do on the data side. We never could have dreamt that 5 years ago. And it's here now, and it's operational, it's not just theoretical.
Exactly. And what we do has to be complemented with market participants. We're in the world of big data, artificial intelligence, heavy load computation. So we're never going to come back to a time where there's less data. There's always going to be more data. The question is, once people like us bring the data to the users, it's only the beginning of the game. Those users, you have to build your own tools and infrastructure to manage the data and to go in the direction you'll set yourself.
I got it. A big round of applause for Philippe.
You.
That was awesome. Thank you so much.